Hi, everybody. So I'm very happy to be with you today and to share our views on the US office market. So actually, there are many signs of a stabilization, if not a full turnaround of those markets when we look at a couple of statistics that have been published recently. Particularly, the net absorption, for instance, has moved back to positive territory end of 2024. Before things are likely to change in Q1 25, but we will come back on that. Availability, particularly for the sublease availability, has actually started to go down significantly end of 2024. So there are a couple of signs that the market has potentially bottomed out. But in the same time, what we are seeing, particularly from the recent measures that have been taken by the Donald Trump administration, are actually challenging that bottom out of the market, and particularly given the impact on from tariff and also immigration policies on the labor market, on the US economy, but also specifically some impacts from the Dodge measures on the office market. So actually, we will start with, so I'm today with Precilla Torres, the head of financing for real estate and hospitality in the US. Hi, Precilla. I'm also with Chris Hodge, the US economist, and we will actually start with Chris Hodge and Roméo Yombo, our real estate specialist, to discuss those views on the US office market. So actually, I think we will actually start with you, Chris, if you don't mind. So Chris, how do you see the impact from the recent Trump measures on the US economy, and particularly how those could actually affect the US office market in your view?
Thank you, Thibaut, and hello, everybody. Yes, we're at a time of considerable policy uncertainty at this point. The immigration policy, trade policy, and the attempts to cut down on the federal job force have certainly caused a lot of turmoil, not just in equity markets, but in bond markets as well, forecast for interest rates as well. It does seem to be, most economists, including us, have marked down our forecast for growth in 2025. We've also marked up our forecast for inflation and unemployment as well. The magnitudes differ a little bit across Wall Street, and also depend on really what you think the resolution of trade policy and policy with regards to the federal workforce end up being. But I think it's safe to say that we're not going to get a clear picture of what's going to happen, at least for the next few months. We do think that we're going to see the peak inflationary impacts from tariffs sometime in the May, June, July, August months. And we think that the Federal Reserve will not be able to ease policy until September at the earliest, with the assumption that the labor market is going to stay fairly buoyant, which is our base case analysis right now. The major question that would threaten that is, what is going on with the Department of Government Efficiency, DOGE? How quickly are those cuts going to come, and where are they going to hit? Now, these questions are unknowable at this point. It does seem like from news reports over the past couple of days, Elon Musk is going to scale back his participation in Doge overall. What that means for the federal workforce reductions is still a bit up in the air, but as you can see from the map here, federal jobs are fairly well dispersed across the country. So you have about 20% of federal workers that are concentrated in the Washington, D.C. and surrounding areas. That's obviously to be expected, but otherwise they're pretty well dispersed across the country, with no huge major pockets of concentration when you adjust for the population overall. Now, using some fairly conservative estimates about what Doge could accomplish, we think that based on the Bill Clinton government reforms of the 90s, that a plausible expectation for a cut in the federal workforce would be about anywhere from 12.5% to 16% or so. That would really be on the high side. Now, again, where those jobs come from very much remains to be seen. But I do think that geographically, we can see that most of them would be concentrated in the Washington, D.C. area. So I don't think that this is a major economic problem overall, but there are certainly pockets of the U.S. where you have military bases, Veterans Affairs hospitals, major post office centers. These are the places that could be disproportionately hit. But as you can see here, it's pretty well scattered across the country overall. So we are closely watching developments for Doge, but we think that 15% reduction in the federal workforce is pretty optimistic at this point, and we think we're probably going to get closer to the range of 8 to 10% or so.
Okay, great. Thanks a lot, Chris, for those insights. And I forgot to mention, so obviously for the audience, please do not hesitate to ask any question in the Q&A section that you can see on your screen, on the right-hand side of your screen. So please feel free, obviously, to ask any question that Chris, Precilla, Roméo, or myself could actually answer after that. So I guess we'll probably move to Roméo, because as you mentioned, there is a part dedicated to the Dodge impact. And Roméo, how do you see the impact from the termination of the 600 lease that has been announced by the U.S. administration? How can this affect actually the U.S. office market in your view?
Okay, so considering like the Trump administration very controversial decision to terminate over 600 office leases, and the federal government brought a plan to divest itself of more than 400 properties, there are three key points to bear in mind. First, let's dive into the lease terminations. The Trump administration chose to terminate an outstanding 679 leases for office buildings utilized by its services. While it is said that these leases represent only 1.7% of the total office inventory across the United States, the implications of this decision cannot be overlooked. Despite the seemingly limited percentage that I just talked about, the timing and context of this lease termination is critical. We are still witnessing a fragile recovery in the office sector. Consequently, this move could lead to negative net absorption in the market, which in turn may drive an increase in the national vacancy rate, a concern that should be on the radar of all stakeholders in the real estate market. Now, the second point, let's consider the regional impact. The termination of these leases will have a pronounced, very sound effect on Washington, D.C. and its surrounding areas, particularly in Southern Maryland and Northern Virginia. These regions, heavily reliant on federal office occupancy, could experience more significant repercussions, as we will see, compared to the rest of the country. This localized impact could exacerbate challenges in an already struggling office market, as many businesses reassess their space needs in the wake of hybrid work models and changing work dynamics. Finally, let's discuss the federal government plan to sell over 400 of its non-core office buildings. This sale and leaseback strategy, while aimed at generating immediate cash flow, pose several risks. Indeed, this could lead to a loss of control over valuable public assets, potentially increasing future costs for taxpayers when the government needs to lease back these spaces. Moreover, given the current state of the office real estate market characterized by an uncertainty and shifting work patterns, the government may find it quite challenging to secure fair market prices for this property. So this could further diminish the long-term value of public assets and increase financial burden down the line. So in conclusion, while the Trump administration lease terminations and the federal government divestment plan may offer short-term benefits in terms of cash flows, they also present significant risks, especially in a market that is still recovering. So if we move on to the next slide, it is very important, I think, to discuss the impact of immigration policies on construction cost, especially after the stabilization we saw since June 2022. So first, historical cost increases. Let's look back at the historical cost increase. From April 2020 and to August 2022, construction costs skyrocketed by 50% due to inflation before interest rates rose. This increase dramatically affected project feasibility in our industry. So the second point is the renovation challenges. Today, renovation costs for updating outdated prime office buildings or converting them to new uses remain higher than pre-COVID levels. This situation complicates our ability to adapt to declining asset values and evolving market demands. And finally, turning to immigration policies, especially those enacted during the Trump administration, stricter immigration measures may lead to labor shortages in construction. A reduced labor force typically drives up labor cost, further increasing overall construction expenses. So all in all, the interplay between rising construction costs and immigration policies presents significant challenges. And we believe that understanding these dynamics is crucial for making informed decisions. But maybe I will let Precilla touch base on this.
Hi, so good morning or good afternoon to everyone, depending where you are in the world. So just quickly, there's a couple of qualitative, broader qualitative considerations maybe I should just touch on. And then, one of which is the increase in construction costs. So first and foremost, obviously tariffs will have, as Roméo indicated, higher implications on higher construction costs. But what's notable, though, more than the conversions that he mentioned, is what I refer to as the math, the profitability of the math in relation to rents. In particular, in the US today, very critical in leasing decisions by tenants is the availability of tenant improvements. And tenant improvements obviously are impacted significantly by construction materials, among other things. So what will happen with increasing needs for tenant improvements as a means to bring in more tenant leases, right? There will be more questions around the ability of the rents commanded, which to begin with are under pressure, relative to the cost of the TI. So in other words, the math there gets even more compressed, therefore adding more pressure on the profitability of these net rents. So that's one critical component that will ultimately impact also the viability of office transaction trades, number one. And the second, as Roméo mentioned, is for sales that are occurring in a number of cases. What is priced in is the ability to convert them to other asset classes, pretty famously really multifamily. So those costs will go up, therefore also impacting prices, obviously, and further exacerbating really pressure on sales prices. One thing in relation to that, perhaps if you can go to slide 9, right? One thing I want to mention is you see the changes in investment volume. In fact, and I will speak to liquidity in general, both for the debt and equity markets. There's been a significant increase, still at the low side, but significant increase on transaction volume for the office sector, which is obviously a very important, I'd say, development. Having said that, what's not obvious here is, what are the prices at which these transactions are occurring. Clearly, it depends for every, it's dependent on every market. But generally, what I will say is what we are noticing is a significant discount on office prices or sales transactions that are occurring relative to what has happened in the past. For example, very recently, there was a trade on 285 Madison Avenue in New York. It had an August 2017 value of 610 million, and it was sold in July of 2024 at 300 million, really to the mezzanine lender of the debt stack. So that's one, for instance, barometer. Another example, and this is in New York also, which is actually one of the better markets in the office sector in the US, 1740 Broadway. There was a 2014 appraisal at 605 million. It transacted in the middle of last year for 200 million. Chicago, where the office market to begin with was very weak, you see even significant, more hefty reductions in value. 200 South Wacker sold for 68 million, which is a 70% decline from a 214.5 million sale in 2013. 600 West Chicago, 88.7 million sale from a 510 million sale in 2018. So that's the one thing that is not as apparent in this graph, which should just be mindful of. Very positive is that there's liquidity that has come back to the equity sector, but obviously it's more on an opportunistic side and or with significant discounts in values. So that's one thing to point out. To perhaps complete the picture on the debt side, I probably should just share some interesting, nuggets around that. So I'd say in 2023, there was almost no liquidity, both in the equity and debt markets. However, in 2024, we started seeing, I'd say, thaw in the office debt liquidity, and that was primarily in the debt capital markets. In particular, there's really two sectors, product sectors. On the conduit side, we saw the inclusion of high quality office with stronger cash flows, permissible in conduit deals, all requiring what we refer to as deep diligence or deep dives by the first loss, or what we refer to as the BP's buyers. Notably, in each conduit transaction, there continues to be a roughly unwritten rule of 20% maximum limit of office per deal. There have been a few deals here and there which exceed that limit, but generally that's the watermark for the maximum office inclusion in conduit deals. Very notable, however, is the SASB, or single asset, single borrower market. No office transactions were done in 2023 in the SASB market. In fact, any transactions that were office that were put out were pulled back from the market. Having said that, since then, there's been meaningful development on office deals. They've become pretty acceptable as an asset class in the growing SASB market. Again, notably, there's been a pause recently and spread widening because of the capital markets uncertainties. However, it's very important to point out that prior to this, and we do expect it will come back once this tariff issue settles down, SASBs were a very efficient debt source for office financing, in particular for the void left by banks for large transactions. In particular, year to date alone, there has been about $10 billion of office SASB transactions done to date. And most recent deal was the Chicago Salesforce Tower transaction. It was completed in the middle of March, just before the Liberation Day tariff announcement. So it's very notable and heartening to see this significant development. And again, spreads have been widening, but our expectation is this should hopefully normalize as the general capital markets normalizes, in the next few months with tariffs settling down.
Yeah, great. Thanks for those valuable insights, Precilla. And maybe just to complete on what you mentioned, actually what we see in terms of investor allocation intentions, and this is what you can see, this was coming from a CBRE survey, which is actually done every year. It is that the share of allocation intentions towards the office market has actually increased noticeably at the start of 2025 compared to what it was for 2024 by 3 points from 10 to 13%. So that actually shows, in line with what you said, that we have seen an increased interest for office recently coming from the US, which is also confirmed by the fact that the cross-border flows going to the US has actually increased recently for the office market, and it was the case actually in H2 24, particularly for some gateway cities such as New York City, for instance. So there are some signs of a US office turnaround, which were multiplying until the recent tariff, which has been put in place by Donald Trump, as we mentioned before. And this is what actually I want to highlight there in that section too. So as you mentioned, Precilla, yeah, we have seen some widening of spreads in general for the debt market, and one way to see that is the chart on the left-hand side, where you see the development of spreads for BBB CMBS. And actually, since the end of March, those BBB CMBS spreads have widened back by 40 to 50 basis points, which has been a very quick widening since actually the announcement of reciprocal tariff particularly. Having said that, interestingly, so far, as you can see on that chart, to us, it doesn't put into question the trend of normalization of spreads for BBB CMBS, which has been put in place since the end of 2023. And that normalization, as you can see on the chart, is actually well correlated to the fact that the available sublease space in the office market has actually peaked end of 2023, and since then has gone down quite significantly, with an acceleration of that decrease in Q4 24. So when you look at the correlation, you can clearly see that as long as the recent measures taken by the Trump administration are not fully changing the picture for the available sublease space, we'll come back on that, but we think that there are structural changes there which are in favor of the stabilization of that market. That would actually mean that BBB spreads will probably come back to a certain tightening in the second half of this year. On top of that, this is also correlated somewhere to the fact that, as you can see on the chart right-hand side, very interestingly, the delinquency rates for office CMBS has actually peaked end of 2024 around 10%, and since then it's actually going down, while in the same time, as you can see on that picture, some other segments have seen the delinquency rate rising, which is the case for multifamily, for instance, which has been one of the best choice for investors over the last 6 to 9 months. So the office CMBS is actually also benefiting from that decline in delinquency, which in our opinion should actually continue to a certain extent in the next couple of months. So that's another support for the market. Then, as I mentioned in the introduction, what we see is net absorption actually turning quite positive until the end of 2024 at least, and most of the providers of information there are agreed on the fact that we have seen a turning point in H2 24. And this is the case for JLL, that's the case for Cuillière and for Green Street too. 3 consecutive positive quarters has been actually mentioned by CBRE since Q2 24. The only one which is still actually showing negative net absorption end of 2024 was Cushman & Wakefield, but even Cushman & Wakefield is actually acknowledging the fact that almost half of the submarkets have actually turned positive in terms of net absorption in Q4 24. So there are definitely very good signs that net absorption has turned favorably in H2 24, at least until the recent Trump measures. And as you can see on the picture right-hand side, it obviously differs from one region in the US to another, and I should say from a city to another. We'll come back on that with Roméo later on. But it's interesting to see that the Northeast region in the US particularly is actually the one to benefit the most from that increase in net absorption compared to the rest of the country. So this is where the market is the more buoyant at the moment, since H2 24. In line with that, availability is starting to go down, and that's very interesting to mention because it's in line with the fact that with a leasing activity which is increasing, and the fact that return to office policies are also increasing since H2 24, that is actually leading to availability going down, and particularly sublease availability after having reached a peak in H1 24. So obviously, this is still a fragile recovery, as Roméo mentioned before, and you can see that on the chart left-hand side, because the recent JLL figures from Q1 25 were actually released, and we have seen that net absorption is heading back to negative territory in Q1 25 after a positive figure for Q4 24. But nevertheless, we believe that there is some good structural factors there, including, for instance, the fact that companies are now turning towards an expansion of their US office building, which is something you can see on the chart right-hand side after 3 consecutive years of contraction. So the picture right-hand side shows you clearly that many companies are actually now thinking about expanding their office portfolios compared to the ones believing in a contraction. And contraction, the companies actually mentioning the contraction in 2024 is down by 15 points compared to 2023. So that's very interesting to see. On top of that, we have, even though it depends again from a city to another, it depends from a month or from a week to another, but globally there is a gradual improvement in the office attendance. So either you see it from Castle in terms of direct office attendance, or the trend which is given by Placer AI with captors, for instance, in order to track who is present in the office. In both cases, what we see is that on average we are back to 1/3 below the pre-COVID levels, and there is definitely a structural trend towards office attendance going back to obviously not normal levels, but probably to go back to something such as -20% pre-COVID levels when you look at the trend in the curves, either on the left or on the right-hand side. So this is definitely a factor of stabilization for the market, supported obviously by return to office policies, which are also increasing since the end of 2024, as I mentioned. So if we actually take all those elements and we factor those elements in a model, in an econometric model, in order to explain the national capitalization rate for US office, depending on A, the level of 10-year rates, B, the trend in net absorption, C, the trend in vacancy rate, but also D, some other factors which are a bit specific to every market, and particularly the question of return to office. Then we come to the conclusion that today, if you look at the picture right-hand side, the average US office cap rate is around 9% on a gross basis, and the NATIXIS model is actually telling you that we should be in the region of 8.6% at constant level from net absorption and from vacancy. So that's very interesting because it means that after the huge correction we have seen since H1 22, and this is what you can see there on the picture right-hand side, we are probably back to fair value in that market, as long as we don't see a full U-turn on the trend for net absorption and vacancy, which means that in case we are seeing a stabilization for both those criteria, we actually believe that there is some potential for the US office market value to recover slightly compared to where it is today. Now, obviously, that's a very heterogeneous market, nevertheless, despite the fact that on a national basis there are some signs of improvement, which could be challenged, as we mentioned before, by the recent Donald Trump measures, including the tariff, but also the immigration policies, as we mentioned before. And one of the factors that we can highlight there is if you take, for instance, the polarization, if we look at the top 5 versus the bottom 5 cities, and we actually look back at what has been the trend in net absorption on a 12-month basis, you see that there are very diverging trends based on each panel, if you take the bottom or the top panel. So as you can see there, if we look at the top panel, we are back in net absorption being positive in Q4 24. It was the case already in Q3 24, and there is a clear acceleration since Q4 23. Now, if we take the bottom 5 cities, in which you have Seattle, Chicago, Detroit, Oakland, and Dallas particularly, you see that at the opposite, things are still deteriorating very massively, and net absorption is actually negative by more than 1 million square feet on average. So it really depends from a city to another, and obviously it also depends sometimes from a neighborhood to another from the same city. So that's obviously one of the key points. Nevertheless, what we wanted to do there is to look at what are potentially the best opportunities to play a recovery from the US office market, including many factors. So what are the factors that we have considered there? Obviously, some factors such as the trend in net absorptions, the dynamics of net absorption depending on the city, as well as the trend in vacancy, the trend in rental growth, the past rental growth and the future rental growth that we could expect, notably from demographics, but also the trend in working from home, sometimes which are different from a city to another. And finally, the impact from the Dodge policies, as we mentioned before, for some cities such as Chicago and particularly Washington, D.C., we could expect that the Dodge impact will be huge because the termination needs are significant compared to the size of those markets, which is not the case in some other cities, such as San Francisco, for instance, on which, on the other hand, the trend in vacancy is still very problematic, given the fact that we are at more than 35% of vacancies in San Francisco and more than 30%, for instance, in Los Angeles CBD. So those are all the factors that we have considered in a scoring grid on which we have constructed Z-scores. And what you can see on that picture is the recap of what are the top and bottom cities in terms of Class A cities for the US market. And interestingly, if you look at the right-hand side of those, you see that cities such as Miami, Nashville, Boston, for instance, are cities on which we think it's very interesting for investors potentially to play a recovery, all things being equal, while for some others, such as Detroit, San Francisco, Chicago, and unsurprisingly, Washington, D.C., particularly given the risk of the Dodge potential impact on that market, those are the cities where we think it's much too early to play an office recovery today. So that's for the global scoring grid, and I will leave again the mic to Roméo, so just to give some more details on what are the top 3 US office real estate markets that we could consider as of now to play the recovery. Roméo?
Okay, so just like Thibaut mentioned, actually this slide highlights the 3 most attractive US office markets. So Miami, Nashville, and Boston, each demonstrating strong demand, low vacancy rates, and robust economic fundamentals. So this rating has been done according to our scoring model. So first, let's dive into Miami. So the office market here is thriving with a low vacancy rate of 60.1% and positive net absorption of 70,000 square feet in Q3 24. Average rents have hit a record 57.9 per square foot dollar, reflecting strong demand for grade A space, up 10.7 year over year. So despite a slight rise in unemployment to 2.5%, Miami's economy is robust and diverse, with 800,000 square feet under construction and a strategic position as a gateway to Latin America, the market is dynamic. An effective yield of 6% and a nominal yield of 10.2% make it appealing to investors. Next, we have Nashville. This market shows resilience with a vacancy rate of 15.4%, below its 4-year average and national averages. Positive net absorption of 1.1 million square feet in 2024 highlights strong demand. Plus, Nashville unemployment rate is low at 2.8%, supported by key sectors like healthcare and tourism, with an average effective yield of 6.6% and a nominal yield of 10.7%. Nashville offers an attractive risk-adjusted return for investors. Lastly, Boston. The office market features a vacancy rate of 70% in Q4 24, lower than the average for major cities. The work-from-home rate is 20.9%, also below the national average. And in 2024, asking rents rose by 5.7%, signaling growth potential. With an unemployment rate under 3.6% and strong tenant retention, with 46.1% of transactions being renewed, Boston's economy seems pretty solid. A 6.3% average effective yield makes it a strong choice for investors looking to benefit from a potential market recovery. So, in conclusion, Miami, Nashville, and Boston appeared as attractive investment market. I will leave the room to Thibaut, maybe to say the last few words about our report. Thank you.
Yeah, sure. So thanks, Roméo. So I think what we understood from that webinar globally is that we have so far some good signs of stabilization of the US office market, as we mentioned before, and those signs have been actually multiplying over the past 2 quarters, particularly the net absorption, the availability, and the investor intention allocations, which are now growing on the office market. So there is a start of recovery that we could actually foresee for this year, but obviously those are now really put into question by the recent measures, and we actually know that the office market is going to be impacted by the termination of leases, which has been decided actually by the Trump administration. So the 1.7% of increase in vacancy that Roméo highlighted before is definitely significant in a market where we have more than 20% of vacancy already. So that's a risk that the recovery could actually be delayed by a couple of quarters. Second, as mentioned by Chris before, we have a risk on the labor market, despite the fact that so far we continue to believe that overall the market is still in a good shape. And obviously, if the trade tariff is going into a real war and then we're going into recession, obviously that's another risk, because then it means a big risk for the supply demand of the office market, which is so far not our first assumption. Finally, another thing that obviously you should take into consideration is the fact that we have seen recently some signs of the safe haven status considered by the US T-note being put into question by some investors, definitely, which is clearly shown by obviously the underperformance of US high yield spreads compared to Euro high yield spreads, but also the depreciation of dollar versus many currencies in the world. So if this would actually be transformed into a structural trend, that would be another risk for the office market, given the fact that if it totally changes our forecast for 10-year rates in the US, you need to keep in mind that we have an average elasticity of the office cap rate in the US to 10-year rates, which is about between 0.25 and 0.3. So that's very significant, and that's a risk. Having said that, we think that structurally we are not so far from a global stabilization of the office market, which will be supported by the fact that we have lots of the expiration of the previous leases is actually diminishing clearly. We have a reduction in the downsizing also, which actually means that the trend in better availability of lower availability of space is something which is quite structural. And if this is the case, as we highlighted before with Roméo, what we think is that the key markets to play that potential recovery or stabilization are Miami, Nashville, Boston, and then after that, that will be part of the New York market. On the other hand, obviously, given the heterogeneity of the US office market, some other markets such as Chicago, Detroit, for instance, but also Washington, D.C., are at risk of a further decline in terms of asset values. Now, maybe that's time for us to turn to the questions, and I can see that we have actually a couple of questions which has been raised interestingly. So I can see one of those. Maybe that could be one for you, Precilla, or maybe Roméo, you will take it too. Is it a viable option to convert vacant office spaces in larger cities into condominiums? Precilla, do you want to take that one?
Sure. If the question is when you say condominiums, because here in the US it means just tax lots. Also, if you're referring to residential condominiums, what I will say is it's really significantly dependent on the to begin with the architectural and engineering underpinnings of the building, because certain buildings don't layout, especially depending on where the core of the building is, right? Because you can't change the fundamental architecture, or I should say so I'm not an engineer, the foundations and how it's laid out in a building. So that's one key piece, and has been a meaningful barrier in a number of cases to a scaled conversion into condos. One thing, for instance, in LA, because downtown LA is one of the office markets that continue to be heavily under siege, right? One of the issues, and this is exacerbated by tariffs, obviously, as we said, in construction costs. One of the issues that is specific to LA, because it's in California, is the retrofitting of the buildings to protect them, I should say, to make it, there's a term for it, earthquake risk compliant. There are certain requirements, obviously, of the municipality if you convert an asset to residential, to make them compliant with their earthquake risk code, right? So, and that's a very hefty number. So there are these, I would say, engineering, perhaps is a better term of saying it, engineering issues that get in the way. So it doesn't make, you can't just assume you can convert an office building into an alternative use because of the engineering makeup, original engineering makeup of a building.
Okay, thanks, Precilla, for your answer. Roméo, do you want to add anything there, or should I move to another question? You're on mute. Okay, great. I can see that there is another question actually on the New York City market. So maybe I can start with that one, and feel free, Roméo, to complete. Well, what you can see first is that the New York market is actually definitely more in the top list that we have identified there, as you can see. Then second thing is that it also depends on the part of the New York market you actually consider. And we are back to the heterogeneity that we mentioned before, and the polarization of the markets. So definitely, in general, I would say the New York market is more in the top markets, and you can see that the New York midtown market, even the downtown, appear actually as one of the best choices for those investors willing to play the recovery in the office market, particularly because the demand is actually quite supportive at the moment. We see rent increase quite favorable. So there are a couple of factors of which definitely are supportive for the New York City market. On the other hand, if you look at Brooklyn market and the Midtown South, given the fact that in those markets the trend in net absorption is not as supportive as it is for downtown and Midtown, those sub-markets of New York City are much closer to, let's say, a stabilization or the, let's say, the middle of the chart. Don't know, Roméo, if you want to add anything there.
I think just like you mentioned, Thibaut, there is not much to add. Like the New York market is really diverse depending on where you're looking at. You won't see the same results. If we take, for example, the Manhattan submarkets of New York City, we have like an historical average of 13.5%, which seems pretty low, but a current historical average of vacancy rate of 13.5%, which is pretty low. But right now we are at 23.3%, which is very high. So even in one of the best submarkets of New York, the context is still difficult. So just like you mentioned, I think it's very difficult to draw a trend for this particular market. Yeah, not much to add on that.
Okay, thanks, Roméo. I think there is maybe another question on which we might have some insights there. Did you identify European real estate companies particularly exposed to the US office market and thus vulnerable because of the ongoing challenges? I don't know, Roméo, if you can think about any real estate companies that you cover that has a presence on the US office market in your coverage.
Not the office market. We have under our coverage companies that are invested in the US market, but not in the office space. So.
Okay, and the same question actually applied to banks. Unfortunately, so the bank analyst is not with us today, but we obviously know that the European banks, which are more exposed to the US office, were actually the ones that were hitting the screens, particularly the public screens, over the last 2 years, notably some German banks that some of you probably know. For the rest, I think the exposure is quite limited. Compared to the total size of the assets. If you take Deutsche Bank, for instance, so I'm not sure that it's significant enough to trigger a change in the credit quality of those European banks, apart again from the small German mortgage banks. And apart from that, I don't know for the others if you can see any question on which you think you could bring some insights. Otherwise, if it's not the case, I would like to thank all the speakers today. So, and obviously to thank also all our listeners. And I hope that was interesting for you, that has brought added value. And obviously, do not hesitate to come back to Precilla, Chris, Roméo, or myself if you need any further insights or comments on those markets. By the way, we are just about to release actually the publications, which is a more complete publication on that trend for the US office market. So that should be in your mailbox probably in a couple of minutes or hours, or maybe tomorrow for some of you. Thank you, and have a nice end of day.
Thank you very much. Have a good day.